Okay, guys. So let's just start discussing about this ACCA performance management. What I have opened in front of you is the CB examination of the which is available on the ACCA platform. And this specific paper that I've actually opened up is the examination available, a specimen examination available on your website for the CB practice platform. As you know that when you go about, there are these instructions. So multiple pages for the instructions. Until the time you don't read the instructions properly, the page does not move forward. So now, what am I going to do is that I've got this specific question, and this specific question is basically going to be one of those questions we are going to discuss multiple areas related to the syllabus. Now, the first thing that I would want to actually go about discussing is that Um, we have got this one of the questions which actually has multiple requirements, as you know, that you've got constructed response questions, and you've got a choice that in case if you want, you can just move the screen this way. So basically, there is one of the requirement which is explain the main principles of activity-based budgeting. That's one of the area. If I could just move on to the second requirement of the question, it says calculate any spare capacity or shortage in the hours required to meet expected monthly output for production machine time, quality control inspectors, and shipping administrators. So you would have to do the calculations for each one of these people, that do you have any spare capacity or do you have any shortage related to these people. Next, the third part of the question is that discuss the implications of your findings in B for trade sports shoes production process. So whatever your findings were, that is in part B. So you would have to discuss the implications of those findings on your manufacturing process. Now let's have a bit of a discussion about it, that how things are going to move. So first of all, let's just read through this specific question so that we are able to know that what is actually going on. So first of all, read through this question. Um, if I could just expand it, it says trade company manufactures the sports shoes and clothing. It is a relatively small company and has a good reputation for producing high quality products. In recent months, however, there have been an increasing number of customer complaints about quality problem with trade companies' sports shoes. So what is their key thing? They have been famous for producing high quality products, but in recent time, what has actually happened is that the customer complaints have gone up. Now it says trade company is profitable. Trade company is profitable, but finance director who joined the company last year believes that there are inefficiencies in its operations and consequently it isn't as profitable as it could be. So the finance director, he says that the company is underperforming. The company has the potential, company can perform quite better. Now what else is there? It says the finance director believes that trade company's budgeting system is partly to be blamed for this. So he thinks that the company is not performing well and the major reason could be because of the budgeting system. Now, he says the company currently uses an incremental approach to budgeting. So you do know what an incremental to approach to budgeting is, that you use the current year's budget, you incorporate the adjustments to the current year budget so that you end up reaching the next year budget. But the finance director believes activity-based budgeting would be more appropriate. So he thinks that activity-based budgeting would be more appropriate. He is analyzing the production process for sports shoes to support his suggestion, and he has asked you for help in connection with this. Trade company produces two different styles of a sports shoe, the deluxe and the standard, and has contracts to supply these to several large retail chains. Much of the production process is automated and production occurs in batches. Similar goods are shipped to customers in batches. Demand is relatively constant throughout the year. Operational data for each month is as each product is as follows. Deluxe is standard. Monthly demand, pairs of shoes produced, production batch size, shipment batch. The production line for sports shoes has a capacity of this. In addition to staff, they employ two quality control inspectors, so and so, so and so. Now, The production line for sports shoe has a capacity of 175 production machine hours per month after allowing for setup time. In addition to staff who work on production line, trade also employs 2 quality control inspectors and 2 shipping administrators also. Each of these employees is contracted to work 150 hours per month and their salaries are treated as overheads. Quality control staff inspect a sample of sports shoes. From each batch produced and the standard inspection time is so and so. Shipping administrators prepare the batches to be dispatched to the customers. Now, the question says that explain the main principles of the activity-based budgeting system. So what are the main principles for the activity-based budgeting system? Let me just guide you people through. I'm just going to write down few of the pointers and I would actually just relate it to this specific company. Now, what happens is that activity-based budgets are prepared on the basis of the data generated through activity based costing. So let me repeat, activity based budgets are prepared on the basis of the data which is generated through the activity based costing. Now what actually happens is that the implementation of the activity based costing requires entity to apply the following steps. Identification of the activities undertaken, that is machine setup, quality inspection, dispatch preparations in the case of trade company, developing of the cost pools, which is to accumulate all the costs related to an activity. The third one of them is determining the cost drivers, that is the actions that drive the cost. In the case of trade company, it would be number of times setups are performed, number of times inspections are done, etc. etc. Activity overhead absorption rate is determined using activity cost pool and budgeted cost drivers. The overheads on the basis of the activities are absorbed. The overheads on the basis of the activities are absorbed as part of the product cost on the basis of number of activities undertaken by undertaken for the manufacture of such product. In the case of activity based budgeting, all above steps will be applied and the budget will be established using the activity overhead absorption rates for each of the activities. Do you people get it? Do you understand this? Yeah, hello. Do you people understand this? Yeah, hello. Are you people there? Okay, so you do understand this, right? Okay, now let's move a bit forward and let's discuss further. The next aspect is that the question says calculate any spare capacity or shortage in the hours required to meet the expected monthly output for production machine time, quality control inspectors, and shipping administrators. So now what is it that we need to do? We need to compare the time available with the time required. I mean, what is it that we need to do? We need to discuss and we need to compare it with the time available with the time required. Now, what are you gonna do? You're gonna say that for each one of them, we have been given the operational data that monthly demand, pair of shoes produced per production machine hour is this, production batch size is this, shipment batch size is this and this. Now the key information here is that the production line for shoes has a capacity of 175 production machine hours per month after allowing for setup time. Now, what happens is that if I talk about these products individually, deluxe and standard, and if I say number one of them is for the machine production machine time, total time required also needs to be established. Now, what do we need to do about this production machine time? We need to say number of machine hours needed. How would we calculate it? We would say 22,500 divided by, so pair of shoes produced per machine hour, 250. 90 machine hours needed. In this case, it's gonna be 24,000 divided by 30 divided by 300 divided by 300. 80 machine hours needed. So what is the total time needed? This plus this is this. Machine hours available is 175. Hence, there is going to be a surplus of how much? This minus this. So you've got 5 hours of surplus. I mean, what have you got? You've got 5 hours of surplus. Is this okay to all? If I talk about quality control inspectors, so it says production batch size is this, shipment batch size is this. In addition to the staff who work on the production line, trade also employs 2 quality control inspectors. Each of these employees is contracted to work 150 hours per month. Number of inspection hours required. How would we get it? We would get it like this. We would say that control staff inspect a sample of sports shoes from each batch produced, and the standard inspection time is 2.5 hours per batch produced. So basically what happens is that number of batches, time per batch, total inspection hours required. So number of batches is gonna be 22,500 divided by 300. It's gonna be 24,000 divided by 400. The time per batch, the time per batch that is needed is 2.5. So it's gonna be this into this gives you the total time, number of inspection hours required. So that is going to be this plus this. Number of inspection hours available is gonna be 2 into 150. Hence shortage or shortfall is gonna be this minus this. 37.5 hour is the shortfall. You have got the surplus, then there is a shortfall. Now next is basically shipment shipping administrators. I would copy the same formula for the shipping administrators which I did for the quality control inspectors. Why? Because it's more or less the same thing here also. We would say shipment batch sizes. It takes 0.75 per batch shipped. So the answer is gonna be here. It's 22,500 divided by 125. It's gonna be 24,000 divided by 150. 0.75 is the time that is needed. Hence number of shipping admin time required. So 255 hours are required. Number of hours available. The surplus is gonna be 45. The surplus is gonna be 45. Is this okay to you all? Okay, lovely. Now, what's the next requirement? The last requirement. The last requirement is basically, it says discuss the implications of your findings in B for trade company sports shoes production process. Now, implications is the impact. Implications is the impact. So what actually happens is that the problem over here is that you've got surplus machine hour available. You've got shortfall in quality control inspectors, and you've got surplus in shipping administrators. The shortfall is basically in the quality inspectors. Now, what is gonna be the implications? Let's have a bit of a discussion about it. If I talk about the implications for this, what is actually gonna be the impact? Due to shortfall in the time available for the quality inspectors, all the products manufactured are not checked for the quality appropriately. This results in, you see what happens is that there is a shortfall in the time available. This results in many of the products to skip the quality control inspection, and hence the poorer quality is passed on to the customer. The impact of this is the dissatisfaction amongst the customer, especially considering the fact that trade company has a good reputation for producing high quality products, whereas due to lack of available time, the quality is being compromised. Furthermore, the shipping administrators have ample amount of time left, which could not be utilized unless the quality inspectors are introduced. Therefore, unnecessary costs are incurred for the shipping administrators, and the result is that trade ends up paying for the unused capacity. Is that okay? This is where the problem is. The overall impact of the above is that profitability of the business is down, plus there is an impact on the reputation of the business which could have impacts on the future revenues and hence the profitability of the business. Do you people get it? Yeah, hello. Is it all understood now? Do you understand the implications, the impact, the problems? Okay, good enough. So we are done with this specific question, the name of which was trade company and it was about budgeting. That is something that we have done now. Okay, so we have got this question in front of us. The name of this question is Clean Feed Company. This is one of the past examination question relating to the area of performance management. What are we gonna do? We're gonna start discussing about this question, Clean Feed Company. Let's have a discussion about this question, Clean Feed Company. Now, it says Clean Feed Company is a large supplier of environmentally friendly products. What is their focus? Environmental friendly products. The company is split into two divisions, the household goods divisions and the personal care division. Okay. So they've got two divisions, the household goods and the personal care. The two divisional managers are responsible for generating revenues and controlling costs. So the managers, they generate revenue. That means the responsibility for sales. They control costs. That means responsibility for cost, and hence it's a profit center. Both of them make their sales and purchases on credit, having negotiated 30-day credit terms with both customers and suppliers. Whilst divisional manager can authorize capital expenditure up to $50,000, any expenditure above this is controlled by head office. So that means major expenditure is head office. All of the head office running costs are shared equally between the two divisions and are included in the indirect cost below. The performance of each division is assessed by head office using ROI based on net assets. So head office, what does it do? It assesses the performances of both the division using the ROI based on net assets. Now, each of the divisional manager is paid an annual salary of 180,000 plus an annual bonus based on ROI achieved of the division. So each of the divisional manager gets a bonus based on ROI. Now what next is there? It says each division is expected to achieve a minimum ROI of 15% for which no bonus is payable. Okay. Minimum ROI is 15% and no bonus would be payable. However, for every whole percentage point above this that the dividends achieve, managers can accrue a bonus of 3% of the annual salary. Maximum bonus can be earned as 10% of the annual salary. During the year ending 31st August 9, head office decided to invest 2 million in a new computer system in division HG, the household goods division. This was against the advice of divisional manager and caused a lot of disruption to customer orders. Due to these issues, head office decided that a similar planned installation would not take place at the division PC. Following data relates to both the divisions, the sales, the direct cost, the indirect cost, non-current assets, inventory, cash, receivable, payable, overdraft. Number of orders completed within 7 days of the order being placed, customer complaints as a percentage of total sale volume, staff turnover rate. So requirement is for each of the divisions calculate the return on investment for the year ending 31st August 2009, the amount of bonus which each of the managers will receive for the year ending 31st August 9. So apparently a simple situation, division HG, division PC. The formula for ROI is basically divisional profit divided by investment. And the investment is equals to non-capital employed. The investment is equivalent to capital employed and the capital employed is equivalent to non-current asset minus current liability. Now, what is actually going to happen? Try to understand this. We're going to say the profit is sales minus direct cost minus indirect cost. 12655 minus 5796 minus 4023. So there is actually a loss for division HG. Whereas when we talk about the division PC, the profit is 22,834 minus 11,134 minus 6078. The capital, or you could rather say net assets. Yeah, yeah, please. Okay, I've made a mistake. Okay, is it right now? Is it right now? Okay, thank you. Now, the net assets are gonna be what? The net assets means asset minus liability. Now, asset minus liability is equivalent to equity. So it could actually be non-current asset minus current liability. So it's gonna be 14570 minus current liability is a 0. It could be 20,698 minus, okay, just wait a bit. The current liability includes the payable and the OD. So hence resultingly the return on investment is going to be this. divided by this. And what are we going to do? We're going to have the percentages for it. So one of them is 20.6%, other is 33.43%. Requirement, the part 1. Now part 2, when we have to calculate the bonus. So the bonus is being paid at what? 3% of the annual. The managers accrue a bonus of 3% of the annual salary for every percentage, for every whole percentage above this that the divisions achieve. Managers accrue a bonus of 3% of the annual salary. So you would say whole percentage above target is 5%, is 13%. They want whole percentage. Bonus per percentage is 3%, 3%. Total bonus is this into this and this into this. Now, what actually happens is that the maximum limit is 10%, 10%. Hence, bonus earned by manager is the minimum of these two. Is the minimum of these two. Hence, it's the 10% that's the bonus that's earned. Now, I'll just take you people through to it. Let me know if you understand this. Yeah, do you people understand this? How do I get the capital employed? Okay, there are multiple ways of calculating capital employed. The capital employed could be, now when you calculate the capital employed could be calculated as debt plus equity. That's one way of doing it. The capital employed could be assets minus liabilities. The capital employed could be okay, it's capital employed is debt plus equity, or it could be asset minus liability. Now let me just recheck if I have made a bit of a mistake. I think that I made a bit of a mistake. In this capital employed, I've taken the other formula. Let's just see. Okay, it's not non-current assets, it's total assets minus current liability it's the total assets minus the current liability is your capital employed. So I'll make a bit of a amendment here. I'll make a bit of amendment here because it's a slight error that I have made a bit. Anyways, 14,570 plus 1286. Thank God we are working on Excel. Plus 650 minus, sorry, plus 1040 minus 800 minus 0. That's what you have. Now here you have 20,698 plus 1984 plus 3753 minus 1650 minus 2230. So it's basically 1%. Because 15% whole percentage above target is 1%. Whole percentage above target is 14%. So the bonus earned is 3% and the bonus earned here is 10%. I made a slight error in the computation of the capital. So, but now we have rectified it. The capital has to be what? The capital has to be your total assets minus current liability. Now, is it okay to you all? Is it okay? Above 15 is 9. Okay, let it be 9%. 9%, right? So it's again 10% is the maximum. Yes, thank you. It's 9%. Yeah, is everyone else okay with it? Now, let's move a bit forward and let's try to discuss further. It says using your answer to part A and the data provided, assess the performance of each of the divisions, including management of working capital. It says there are 4 marks for calculations and 8 marks for discussion. Now, can you just look at this question and try to see that how exactly are you going to draft your answer to it? 4 marks for calculations. So what type of calculations can you do? And how exactly are you going to draft your answer? Can you just have a look at it? Yeah, is it done? Let's have a discussion on this. It says using an answer to part A and the data provided, assess the performance of each divisions, including the management of working capital. Now, if you actually, number one, what I would do is that I would calculate the ROI based on controllable profit. What would happen is that sales minus the direct cost, controllable profit. Now, what happens is that we have got the net assets available also. So hence ROI on controllable profit. Now the sales is 12,655, 22,834. The direct costs are 5,796. The direct costs are 11,134. The controllable profit is gonna be what? I bet the controllable profit is gonna be the controllable profit is gonna be 12,655 minus 5,796. 6,859. 22,834 minus 11,134. 11,700. The net assets right now, we just calculated them also. 16746 22,555. Hence, ROI based on controllable profit is gonna be 40.96%. Then what happens is that 11,700, 51.88%. Now, what is it that we need to do? Just try to understand. The requirement is using an answer to part A and the data provided, assess the performance of each division including management of working capital. Working capital of both divisions. Division HG, division PC. Current asset minus current liability is equivalent to 1286 plus 650 plus 1040 minus 800. Is 2176. For this company, the current asset minus current liability is gonna be 1984 plus 3753 minus 2230 minus 1650. Now, what is actually going to happen is here, what is actually going to happen over here is that based on the available information in part A, the HG division has only earned a profit of 16.16%, whereas whereas PC division has earned ROI of 24.9%. This indicates that PC division has performed better than HG division. However, considering that indirect costs are the allocation of the head office cost to each of the segments, each of the divisions, considering that the indirect costs are the allocation of the head office cost to each of the divisions, the controllable profit is determined for each division as above, and on this basis both divisions have performed well for the ROI such that both the managers would have earned bonuses to the maximum limit had the bonus been based on controllable profits. The working capital of PC is also better managed as compared to that of HG, as PC has lower investment in working capital. However, it is relying on overdraft, which is a short-term source of finance. Furthermore, %99 of the orders were completed within 7 days of the order being placed for the HG in 2000X8, and this has dropped to 80% in 2000X9, indicating that performance of HG has deteriorated. whereas there is a nominal decrease in the percentage of orders completed within 7 days for PC. In respect of the customer complaints, the HG complaints have increased 10 times of the complaints previously made, whereas whereas that of the PC have doubled over the last year. The staff turnover for HG is maintained, whereas that of the PC has increased significantly, and that could largely be due to strict actions being taken by the manager to ensure fulfillment of the target. Based on above, it could be concluded that the of performance of PC is better than that of HG, except for the staff turnover rate in PC, which is likely to be high because of the lack of leniency being showed by the management. So it is apparently the management is strict, and the strict management is forcing the employees from PC to leave. But at the same time, that strict management is ensuring that the results are produced. At the same time, that strict management is ensuring that the results are produced. Yeah, is that okay? Yeah. Yeah, because the reason being that the examiner has not told anywhere that what is the profit on the basis of which the bonus is being given. So because you see, we are not evaluating the performance in part A. We are actually calculating the bonus and the requirement, right? They did not say anything that how do they calculate. All that they say is that head office, performance of each division assessed by head office using return on investment based on net assets. Now, if they did not say anything, so I've just assumed that it is going to be on the basis of overall profit. It should be, it should be, it should, it should be, but the problem is that the, I mean, that's the right way of doing it. But generally the companies, they don't do it. So unless the examiner actually keeps more marks for the calculations, you don't do the controllable profit directly. Or if the examiner asks you what is the appropriate ROI, he has simply asked you for the ROI. So you could just do it from the basis of normal profit. And you see, I've done the evaluation in the other part. Maybe we could just try to check out the examiner's answer on it also. But you see, what happens is that uh, to me, based on the situation where nothing has been given and I am specifically being asked to calculate the bonus, so I would go for the normal ROI calculation rather than controllable, right? Okay, uh, we might actually try to check out if there is any answer available to this question also, uh, right? But for the time, just keep it like this. And I've actually done this controllable profit calculation here also, because this part is giving me an open invitation to write down whatever that I wish to write down. In case if you people would like to add up any points to this part, do suggest. Are there any points that you people can suggest? Yeah, hello everyone. Are there any points that you people can suggest? Okay, now seems like no one has any points here. Okay, lastly, okay, can you people suggest any pointers for the above? Yeah, can you people suggest any pointers for the above? Yes, it's basically available on the ACCA portal. Yeah, please, anyone, any inputs? Okay, I could just say that discuss whether the return on investment as a basis for assessing divisional performance and calculating bonus at clean feet is appropriate, taking into consideration any issues which it may cause. So now let me just give you an idea. Basically, what's going to happen? You could just try to see that the investment is not 100% under the control of manager, and instead head office decides about the investment. The profits excluding the indirect costs allocated by the head office are under the control of the divisional manager. Always appropriate to evaluate performance on the basis of items which are controllable. So controllable profit is a better measure rather than using ROI, as the investments are not wholly within the control of the divisional managers. Residual income could be used as an alternate, but it is also impacted by the investments made. Because you see, residual income also has the profit minus the income multiplied by desired rate. Is it okay now? Yeah, Savio Pais, do you understand this? That residual income also has got the same thing. It's like profit minus the investment multiplied by the percentage return. So investment is also there. Okay. So what have we done? We have been able to do the calculations for these questions. And we have actually concluded these constructed response questions related to this specific paper. Now, is that okay now?